Hello, welcome to another video. The escalation of the pandemic through business has been significant, and there has been special provisions brought out to help businesses survive it by HMG, including the coronavirus job retention scheme, self-employed income support, deferral of VAT, and various grants and loans that have been made available. But I thought I would give a talk about some of the mainstream tax planning that we would often undertake for clients that could be used in these circumstances and could actually be quite beneficial. Some of the things are sometimes overlooked simply because they're not discussed in advance or they're not known about. None of these are exciting, adventurous stuff. There's no schemes or anything involved here. They are very vanilla and will certainly be applicable to you if the circumstances are right. I've got 10 or 11 ideas for you. The first of which, maximize capital allowances. Capital allowances are a tax allowance that's given for the use and wearing of assets in your business. Assets are things that you hold in the long term, not short term. So, a piece of equipment that you use long term, a building that you hold long term. If you have bought anything, if you have bought a building in the last few years, I think if you haven't already reviewed the capital allowances available to you, it's certainly time to do this now. Because what capital allowances do is give you a relief against tax, thereby reducing your taxable profits. Now, if you reduce your taxable profits, not only are you paying less tax now and retaining cash within the business, you're also giving the opportunity to change previous tax returns and reclaim any tax that you have previously paid in the past. There are time limits on it, but structural building allowances and embedded capital allowances, that's the looking at the stuff that's within the buildings, is certainly something that's worth doing. Now, these have to be on commercial buildings, it's not residential. So if you have acquired something like this in the last couple of years, please do let myself or Jamie know and we can discuss it further with you. Something else to watch out for: if you're considering buying any substantial pieces of equipment for your business, I would urge you to do it before January 2021 if they are going to be worth more than £200,000 in a 12-month period. Now, that's an awful lot of money, and it's not going to be applicable to everybody who listens to this, but I do know of certain people who it might well apply to. So if you're buying a substantial piece of kit that's worth more than £200,000, or a number of pieces of kit that in total will come to more than £200,000, do so before the 31st of Jan 2021, because the limits change. For a short period, you can actually buy £1 million worth of equipment and have it subtracted from your taxable profit in one lump, whereas after that you can only buy £200,000 worth. Now, again, the point of doing this is to get equipment that you need for your business now and have it available to you now, and reduce your taxable profits and pay less tax, or even carry a loss back and get back tax that you have paid in the past. So that's one area. The next one, research and development. Now, research and development is something that we're going to be discussing a lot with you over the next few months. We were about to have a significant campaign with clients about research and development tax credits before the pandemic kicked in. It then did start, and for obvious reasons, we put it on the back burner. Now, research and development does not mean you have men in white coats in a laboratory, which is what a lot of people think it is, and it really isn't. It really isn't men in white coats in a laboratory. It's anybody that makes something will probably have research and development tax credits available to them. Now, make something can be a service, it can be an intangible software, it can be a thing. The obvious ones are things. If you make something and you have looked at a way of making it differently, or you have had to come up with a way of doing something that has not been done in the past and is not already available, you will have R&D tax credits available to you. Now, we can do this for you. We as CCM, both myself and Jamie, can take care of these. We will need a few hours of your time. If you want to just have a discussion about it, that can be done on a telephone call. That's quite quick. What we will need is the details of the objective of what we did, the method that you did it, and the conclusion of what you came to. It doesn't have to work. It could have actually failed, but that's a point for the moment. The purpose of looking at R&D tax credits from a tax point of view is the tax relief they give to you. For every pound that you have spent developing your thing, you get £2.30 subtracted from your taxable profits. What that means is it is a significant tax reducer, massive tax reducer. You spend £10,000 on developing something, it reduces your taxable profits by £23,000. Now, that £23,000 then can be either offset against the profits in the year, or actually it can be turned directly into cash at 14.5% of that £23,000, and you can physically get back a check from HMRC if you are in a loss-making situation. The better route is either to offset against your tax now, or if it produces a loss in this year, carry it back to a year where you had taxable profits. Now, we can go back 2 years to do this. So if you have paid tax in your company 2 years ago, we can look at reclaiming that by doing R&D tax credits if you make things that haven't been made before, be they a service or be they an actual tangible thing that you kick. I will be sending out a range of postcards about these, and I will be talking about it again in future videos, but really, really do consider R&D tax credits if you do things. A couple of practical examples to give you to float your ideas going. A joinery company applies. An engineering business applies. A manufacturer of covers apply. A installer of resin-bound driveways qualifies, and a writer of software have all qualified from our clients. There's almost every client will have something. So please do talk to Jamie and I about that. The next one I'd like to just bring up is if you have made a loss this year because your trade has been poor, we can take that loss and carry it back against previous years. Now, by carrying it back against previous years, what that allows us to do is to change those previous years. And if you paid tax in those earlier years, get a refund of the tax paid for you now, thereby generating cash now and ensuring you have no taxable liability. Now, if you have a 31st of March year end, which a lot of people do, you may actually be have a full year set of accounts that are basically normal, because a lot of people didn't really start suffering the effects of the pandemic in their business until late March, which means it may be worth talking to us, and this is any of the senior team, so myself, Mandy, Catherine, Andy, Matt, Jamie, Mo, about extending your year. Extending your year from March, pulling it through to say June or July when you started to trade again, and capturing that loss in the same set of accounts. The reason for doing it that way is it will allow us to crystallize the loss earlier, capture it earlier, and get the tax relief earlier than if we leave your year end where it is and it continues into the following year. In other words, you can do it, you can get that tax benefit now rather than in about 18 months' time. In the same vein as this, if you have made the decision that you are not going to continue to trade, and because you have made such a loss that your business is over, definitely ring me. Now, this would be me as opposed to any of the other senior team. Andy does have some awareness of this, but once upon a time, I used to be an insolvency practitioner assistant, and I spent a lot of my earlier part of my accountancy career in this. So I am very aware and familiar with the tactics and tools that are available for both turning around a business, how an insolvency practitioner should undertake their work, and then the tax processes that can be put in place to capture and gain terminal loss relief. Now, I have a very good contact who's an insolvency practitioner, so I would certainly refer you on to Steve if you are in these situations and difficulties. But before that, don't just assume your business is over. It can actually be turned around in most circumstances, and particularly with the bounce back loans that are available now, I would urge you to look at taking these if you haven't already. Specifically in terms of terminal loss relief, if you have made a loss this year and you are ceasing trade, I can actually carry it back for 3 years, not 1, which means I can certainly look at periods where you did earn money and again seek to get tax refunds. It's worth mentioning time to pay arrangements. We've talked about this throughout the pandemic. The results we're getting from HMRC at the moment are that they are the softest they have been since 2008, 2009 at arranging time to pays. We managed to get an £80,000 deferral of tax, that's VAT and PAYE, spread over 12 months with no interest on a phone call. That's very significant. It's a very, very generous approach that they're taking at the moment. So please do consider making use of that. You have to talk to us. We can help you. Unfortunately, HMRC do want to often clarify points with you as the individual business owner, and at times we can't completely get the deal away ourselves. We do have to involve you. We at the moment don't make any charge for arranging time to pays. Before the pandemic we did, so we are giving away substantial value at this point. We used to charge 5% of the value of the time to pay. So in the case of the £80,000 deal, we'd be looking at a £4,000 fee. But we have completely waived that for the rest of 2020 to support and look after our people as much as we can. If you are struggling, I would again urge you to talk to me if you are still withdrawing money from your business. Very, very standard approach, and one that we take with almost everybody, is to suggest a small salary, dividends. Now, salary goes through the payroll, and Diane looks after that for you. But the dividends are legally an appropriation of profit. What that means is that you calculate the profit of the company, tax it, and then distribute it to the owners of the business. This is very tax efficient normally. It saves a significant amount, particularly in terms of national insurance. And I believe I've shared several times the different savings that can be made that way. Certainly, if you look at the last 3 years, if you've had £18,000 of dividends a year, you will have saved over £7,500 in tax by doing so. But at the beginning of this, I said they are an appropriation of profit. That means you have to have made a profit. Now, if you're loss making at this time and taking dividends, you can end up in a world of trouble. The first thing is they now become a loan to you. The loan is taxable. It's taxable at 32.5%. That's very painful. It also becomes a benefit in kind. The benefit in kind means you have to file a P11D and pay employers and employees national insurance on that. Now, the employers is another 13.8%. The employees is 12.8%. You see that this becomes extremely tax disadvantageous at this point if you have taken monies out which can't be covered by profit. It is cheaper to turn that into a salary. So if you're loss making and you're taking money out of the company, I would urge you to talk to any of the senior team, because we do need to look at moving you from dividends to PAYE. The other issue is one of legality. If the company fails and you have taken dividends that do not come from profit, they are illegal. This is a breach of company law. They are recoverable by any insolvency practitioner against you personally. So you cease to have that ability to protect yourself, and it becomes a personal liability. At its worst, and I have never seen this happen, but at its worst, it is a potential criminal offence. So you do urge you, talk to us as soon as you can if you know that you are struggling. By the way, in terms of talking to us, the best way to get hold of me is email. If you do the email, even if your email is to say, please, can I arrange a phone call? The bottom of every email I send under my signature is a link to my diary. It's a live link, and you can always book a meeting on a phone call, on a Zoom call, on there directly at any time. Very happy to take those. I do tend to get quite booked up, so that's the best way of ensuring that you can get me. Andy works the same, Jamie, Mandy, all have similar things. They may have a little bit more availability than I have, though. That's the only thing. I've touched on restructuring the business. Again, I have plenty of direct experience of that, and I also have lots of contacts in terms of insolvency practitioners. If you're struggling, talk to me. If you have lent money to your company and the company fails, it's become an irrecoverable loan. If you've lent money to your sole trader partnership business as well, it's an irrecoverable loan. The irrecoverable loans have certain tax advantages that you can get. I know you've lost money, but you might as well make the best of the situation. If you're in that situation and I see it, I will talk to you directly about it. If you think you're going to be in a situation whereby the company or business is not working and you have put money into it, talk to me again. We can get you tax breaks for that, both on an individual and corporate basis, depending on where exactly it is. And the other things to think of as well is if you are actually winding up your company completely, it's come to the end of its life, there's assets there. Those assets, that cash, those assets can be got out quite efficiently, but you do need to talk to me to make sure you do it. There's a lot of rules around this. It's very much a legal process. If it's less than £25,000, I can do it for you. If it's more than £25,000, I have to make introduction to an insolvency practitioner. But it's something that we have done quite a lot of actually in the run up to the pandemic to do with personal service companies, voluntary liquidations, members voluntary liquidations, creditors voluntary liquidations are a very tax efficient route. Extra statutory concession 16 as historic is another good way of getting money out. Essentially, you can get the cash if you're ending your business or the assets for 10% tax. Probably the cheapest thing you can do in terms of getting cash out. There are limits. The limits have changed, but the limit is unlikely to be breached for anybody that's watching this. Again, if the company is at an end and there's no cash in it, the shares have become valueless, there are tax breaks that can be got for you in those circumstances, a negligible value claim. Again, let me know, let Jamie know, let Dan and Sharon know. We can make sure that's on your tax return. And that is quite a techie one. I know that's quite a lot of information. I know that's quite a techie video. There's a lot to take in there. I'm trying to just say to you that I don't always know what's happening. We don't always know what's happening. With the best will in the world, we try and reach out as much as we can, but not everybody lets us know what's going on. So if you are experiencing any sort of cash flow issues at this point, do talk to me. If you are developing and growing, talk to me. Either which way, we can certainly help. We can plan your taxes as much as we can. Anyway, I hope this has been useful. Thank you so much for listening. I always do appreciate it. I'm getting quite a lot of views on this, well into the couple of hundreds, and that's quite amazing for me. I will see you next time.